Okay. Good afternoon, everyone. On behalf of Go India Advisors, a very warm welcome to everyone joining us for the analyst meet of Finbud Financial Services Limited, India's leading
Ra-
hybrid loan aggregator.
Rashi,
Finbud,
Rashi, there's echo at your end.
right. Is this better?
Yeah. If you're using, let's restart, huh?
Sure. Okay. Right. So just start again. So good afternoon, everyone. On behalf of Go India Advisors, a very warm welcome to everyone joining us for the analyst meet of Finbud Financial Services Limited, India's leading hybrid loan aggregator. Finbud Financial Services is a tech-enabled loan aggregator and distributor connecting retail borrowers with banks and NBFCs through a phygital model that combines digital and agent-led sourcing. The company delivered strong revenue growth from 135 crores in FY23 to 223 crores in FY25, reflecting a CAGR of 28% while sustaining a phenomenal ROE of 23.6%, one of the highest within its peer group. Finbud's asset-light operating model provides significant operating leverage and scalability. As the only major player integrating both conventional agent led lending and digital channels, Finbud achieves superior efficiency and scale. Pre screened customers sourced through its agent network enable higher lender conversion rates compared to pure play digital or traditional DSAs. Meanwhile, its digital platform enhances customer re engagement and cross selling opportunities, driving retention and long term yield per customer. This balanced phygital approach minimizes customer acquisition costs, ensures sustainable profitability, and positions Finbud for continued high quality growth at scale. We have with us present here uh, Finbud's management. So we have Mr. Parth Pandey, who is a whole-time director, an ex-Citibank VP with over 18 years of experience in retail lending and credit cycle management. He managed $1 billion retail asset portfolio at Citi before co-founding Finbud, and today leads the company's digital business, including product, marketing, analytics, and technology initiatives. Mr. Vivek Bhatia is a whole-time director, is an entrepreneur with over 20 years of experience across financial services and manufacturing. Before co-founding Finbud, he partnered with Citibank for retail asset distribution through his proprietary firm. At Finbud, he oversees operations, human resources, and the South India agent network, driving scale um, and process excellence. Mr. Parag Agarwal, who's the whole-time director and CFO, who is a former VP of investments at Masan Group and investment manager at Avigo, with over 20 years of experience in investment management and financial services. At Finbud, he leads finance, investor relations, and strategic planning, ensuring capital efficiency and governance discipline across the business. Kindly note that today's discussion could include certain forward looking statements, and we request you to rely solely on the offer documents for any investment related decisions. Further note that we would request you to refrain from any unauthorized recording of the session. And with this, I'd like to invite Mr. Parag Agarwal, who will be walking us through the company's business structure and strategy. And post that, we'll open the floor for questions. Thank you.
Yeah, Parag, over to you.
Yeah. Rashi, are you going to share the presentation?
Yes, I'm just sharing the presentation. Okay. Can you see my screen?
Yes. Maximize the screen.
Sure.
The next slide, Rashi, please.
Sure.
Yeah. Next. Good afternoon, everyone. This is Parag here, one of the 3 co-founders of the company. So we'll quickly run you through the main slides of the presentation, and then we'll leave the floor open for more question and answers so that it can be interactive and most of your queries can be solved out. So Finbud is a retail loan aggregation platform wherein it helps retail salaried customers and SME customers to get unsecured loans from various banks and NBFCs. The 3 products that we primarily help the customers get a loan from the banks and NBFCs are personal loan, business loan, and we have a small amount of secured loan in the form of home loan and LAP. The company was set up in 2012. Today, we are probably the only large player who has a full stack model. By full stack, I mean we acquire customers, we process the application of the customers, which basically entails matchmaking the requirements of the customers with the various credit underwriting requirements of the lenders. And then we handhold the customer till the final disbursal process. So we are the only large player who has both the full stack model as well as on the acquisition front. We are the only large player having a phygital model. So we have a traditional agent-led acquisition channel wherein we have close to 2,500 plus master agents who help sourcing customers with us, who help sourcing customers for us. And then using this channel as a primary customer acquisition strategy for the last 10 years, we have built up a customer database, a strong, insightful customer database of close to 4 crore borrowers. Once we have this customer base with us, then on top of that, we have our digital channel, which does a remarketing and cross-selling on these customers to for their subsequent requirement. So we'll be the only large players having both full stack model, agent-led acquisition channel, as well as a digital-led channel. Today, we have a presence, we have the ability to serve customers across 19,000 plus pin codes, and we have a presence either through our office or through our agents on 30 plus states. Last year, we closed, the last financial year, we closed with a top line of 223 crores and a bottom line of around 8.5 crores. The company traditionally, historically, and as our DNA has been built on a very, very capital efficient structure. Till about last year, when we had a primary round come into the company, we had raised only 4 crores of capital, equity capital into the company. And then last year, we did a fundraising round, which was spearheaded by Ashish Kacholia, Ashish Kacholia, which took our total fundraising till to about 19.5, 20 odd crores till date in the company. Rashid, next slide, please.
Sure.
Yeah. So this is something that we have touched upon. The next one. Yeah. So now I'll briefly touch upon the 2 main business segments that we have, which is the agent-led segment as well as the digital segment. On the agent-led segment, we, as I said, we work with close to 2,500 plus master agents. So when we started off in 2012, we realized that the agent segment is fairly unorganized and fragmented. So we decided that as a strategy to build our case, we first thought that we would try to organize this market and try to consolidate this market. This was also driven by the fact that the other business, which was the D2C, was a high cash burn business. And obviously at that time we were capital starved, so we did not have the necessary resources to invest out there. So what we realized when we built the agent model was that there are 3-4 things that the agent is primarily looking to work with us for. He was looking at a platform which gives him access to possibly all the lenders and all the products that he works with. So which was something that Finance Buddha was able to offer to them. So today we work with close to 125 plus lenders on our platform. We work with all the large banks and NBFCs like HDFC, ICICI, Axis, Kotak, large NBFCs like Bajaj, Tata Capital, L&T Finance, Chola, Aditya Birla, as well as the smaller banks and the fintech players like Unity Small Finance Bank, IndusInd Bank, RBL Bank, and a whole host of the fintech lenders like Five, Early Salary, the digital teams of some of the other lenders. So we were able to give all the lenders as an option to the agent's customer. So that was one of the reasons why he chose to work with us. Second, by working with a large player like us, he tends to get a better commercial than he would have gotten had he been working directly with a bank. So for all the banks and the NBFCs, the payout structure is volume linked. So obviously we are able to aggregate demand at scale, and hence our commercials are better than an individual agent. And hence he sees an uptick in his commissions that he can get from us. And thirdly, and most importantly, for a small agent who has typically, say, a 10 to 20 member team under him or her, they do not have the financial capacity to hold on to the working capital cycles that a bank has. So today, on an average, the bank pays us roughly around 60 to, in some cases, going up to 90 days also, post the end of the month. Now, for a small-time entrepreneur, micro-entrepreneur like our agent, he would not be able to grow his business if that kind of a working capital investment was to be required. So we help in upfronting that payment for the agent. And we are able to do that in a fairly risk-free manner, because what I touched upon initially, that we are among the very few players who has a complete end-to-end process, wherein once the agent gets the customer on board on our platform, we help him in processing. So we know with a very, very high degree of certainty that the loan has finally gotten disbursed, and hence we are able to pay the agent upfront, because our receivables in turn are from banks, and these are Class A receivables. So there are no issues in the collections as such. It's just that we are able to shorten the working capital cycle from probably a 60 to 90 days to, say, 0 to 15 days for an agent. Also, over a period of time, what we have realized is that these agents, they don't have any access to formal capital, and hence that becomes a huge bottleneck for their growth. So over a period of time, agents with whom we have been working for a long time, who have good reputation in the markets, we tend to invest in their business also. Typically, an agent requires some capital to set up a new office or to expand to a new geography, or he wants to hire a new team, which requires some investment upfront. So we make those kind of a growth capital investment with the agent, which we recover over a period of time. So these are the broad three value proposition that the agent sees in working with a large player like us. In addition to that, obviously, from a bank's point of view, we being a variable acquisition channel, so that helps reducing the acquisition cost for a bank also. The next slide, Rashid, please.
Sure.
The one next.
Yeah.
Yeah. So now this agent channel is a high volume but a low margin business. Typically, the margin profile for a agent business is roughly in the 4 to 5% range. So over there, a large portion of the expenses to the agent for acquisition, and there are some costs that we incur for the processing and our manpower cost. However, the way we look internally on our agent channel is that this is a very, very important customer acquisition channel for us. So what other online digital players, the likes of, say, Paisa Bazaar, India Lens, Bank Bazaars, and various other players, what they would be spending millions and millions of dollars to acquire these customers, we have in a very strategic manner built that database through our agent channel, which is today in excess of 4 odd crores. Now, on these customer segments that we have sourced through our agents, we have some very important credit related information of those customers. So we have the demographic profile of the customers, we have the income profile of the customer, we have the employer details of the customer, and we also have the entire credit history of the customer, how the customer has performed on the bureau. Because once the customer comes onto the platform with the necessary authorizations, we have access to their credit profile also. So that helps us having gainful insights onto the profile of a customer, that which category of customer is most likely to take a loan, which category of customer performs well or does not perform well, and so on and so forth. So once we have built this database of 4 crores, that is where our D2C or the digital business segment comes in play. On the agent channel, what happens is that once the agent sources the customer, we do some kind of a gating profile, we do some kind of matchmaking at our end, and then we send it to the lender. But over there, the approval rates tend to be only around 40% because at that time, I don't have that insight in a customer. What my digital or the D2C channel does is, once I have got this customer, now I'm able to run a whole host of data analytics on this customer, and then cherry pick and select the customer which we feel for the subsequent loans will be eligible with the customer. So over there, the entire approach is itself turned upside down. So what we do out there is that we have deep technology and API integrations with all the lenders. Today on that platform, we would be having close to 14, 15 lenders, wherein we have the ability to source, process, matchmaking, run our proprietary algorithm, as well as disburse the entire thing digitally without any manual intervention with close to 15 plus lenders. So out there, what we do is that we have the rule engines of these lenders on our platform. These lenders share their PRE, their underwriting profile, their underwriting rules with us. And on the basis of that, I run a campaign first on our, say, 4 crore odd customers to see what customer segments, which customer is today pre-approved for a loan. It is only on that subset that we run our marketing and digital campaigns. So out there, once a customer has shown an interest, the approval rates over there tend to be as high as 80 to 90%. Now, in our business, this approval ratio, which is 40% in a traditional lender versus an 80% in a digital, is the entire operating leverage towards exponential margins in our business. So I touched about that we are in a mid-single digits margin profile on our agent business. On the digital segment, that margin profile is close to 3 odd times. Because of these targeted marketing, targeted campaigns that we are able to run on our entire base. So that is how the digital segment does. Now, in the digital segment, what it also helps us achieve are a various whole host of cross-selling opportunities, which in our traditional segment, it is kind of bottleneck because of the involvement of the agent and so on and so forth in the entire value chain. So, for example, we did our analytics on the customer base, and then we realized that what are the possible adjacent products that we can sell to a customer. So, for example, last year we first tried out with some insurance and health insurance products, but then we realized that that is something that our customer already probably has, either as part of his employment profile or on an individual basis. But we realized that there's a gap in a wellness product. So there's no insurance cover which covers for an OPD expense of a customer. So a doctor's visitation fee, a diagnostic expense, or a medicine expense. So for that, we tied up with an aggregator called Alive, and we launched our own co-branded wellness product. Within a year's time, that business has scaled up to 50 lakh plus kind of an insurance premium on a monthly basis. Similarly, we realized, since we have access to the bureau profile, we realized that a lot of our customers who were getting rejected had access to certain secured assets in the form of gold loans. So, and also in the form of used car loans. So what we started around 6-7 months back is to retarget our rejected base of unsecured personal loan customers to see if we can cross-sell them a gold loan product. Within 6-7 months of time, that business itself has scaled close to 50 odd crores of disbursal. So there are various such adjacent products that we have launched in the last 1 year, and which we will be launching going ahead once we have access to the funds raised from the IPO. Rashi, next slide, please.
Sure.
Next one. So this just talks about our positioning versus the pure play traditional franchisee-led businesses like an Andromeda. So an Andromeda historically had a franchisee model wherein in a city they would probably lend out their names to 4-5 such players. They would run their business on their own, and at the end of the month, they would send an MIS to Andromeda at the head office for their payouts. Not having an end-to-end stack prevents them from building the kind of database that we had. Obviously, Andromeda has been in business for the last 2.5 decades. So they would have also had access to these customers. But since theirs was not a full stack model, they did not have the ability to build this organized database that we have. Then we have the likes of Paisabazaar, PB Fintech, which I'm sure that most of you all would be aware of, which are purely on the digital mode, who continue to lose money on customer acquisition because they don't have the traditional model that we have for our customer acquisition. For us, our customer acquisition is a customer acquisition plus with a positive contribution. Whereas players like Paisabazaar would be spending almost 2.5x of the first loan revenue just to acquire that customer. Next slide, Rashi. Rashi, can we go to the next slide?
Yes. Is it showing you the next one now?
No.
Oh, I think screen share is paused.
Okay, I'll run through it. So this is what we had done till now. I'll quickly run through our basic IPO quantum and what we intend to do out of those proceeds. So we are looking at a 71 odd crore kind of IPO, entirely primary issue into the company. The broad usage of the IPO proceeds are 3 or 4. Around 20 odd crores out of that proceed goes towards working capital. So as I had initially said, working capital is the key lever for me to grow my agent-led channel. Over there, the more money I'm able to invest in working capital, I would be able to get a customer from a competitor who's ready and willing to work with us. Now, I need to make that investment, even though that's a slightly lower margin, because that is the bedrock, that's the foundation for my entire D2C and the digital business. So 20 odd crores we have earmarked towards working capital for exponentially growing our agent-led business. Roughly around 18 to 20 odd crores again goes towards our entire investment in technology, analytics, marketing. Today, our digital business accounts for close to 15% of our business. But we have been short-staffed. We have not been able to invest as much as we would have wanted in that particular segment because of capital constraints. So that is something that we intend to rectify to some extent with this capital. Then we have earmarked a 15 odd crore investment into our currently 100% subsidiary, which is an NBFC entity. So this NBFC entity, LTCV Credit Private Limited, was something that we had set up in 2018. However, we tried initiating some activity in that company in the past, but then we realized that there were too many things on our plate, and we kept that on hold. So currently, that's a entity which has the NBFC license, but we have not undertaken any robust lending over there. However, in the last 1 year, what we realized is that this is probably now a good time to explore that entity also. So what we have done is we have gone ahead and we have hired a solid management team who will run that business on its own. We have got somebody who has had close to 2.5, 3 decades of experience in lending across large multinational international banks like Citibank, across NBFCs like Plex Capital, Paytm, HSBC. So we have hired, we are speaking to him for him to come on board to lead the initiatives in the NBFC, and along with him, team to build out the entire risk and technology, which has already come on board. So as part of our fundraise, we are looking to invest 15 odd crores in the NBFC. The NBFC is parallelly also doing a fundraise for close to 75 odd crores. Out of that 75 crores, 15 crore is going to be the parents' contribution from our side. And then there is a small, I think 2 to 4 crores, which is for debt repayment, and the rest is for our for general corporate purposes. So that's the overall fund usage. Broadly, if we were to talk about our growth plans, Rashi, if you could just go to the 4-5 slides ahead.
Sure.
Next. Yeah, this one, the previous one. Yeah. So broadly for our growth initiatives for the next 3 to 4 years, A is a continued expansion of our agent-led channel into we already have a large presence now in the metro and tier 1 cities. As I said, that working capital investment will help us to further deepen our presence in tier 2 and tier 3 cities. So that is one of our growth drivers. Second is on what I had briefly touched about, that now we have this 4 crore of database. We have tried and tested with a couple of cross-selling products. We have been successful with most of them. We have also been unsuccessful with a few. So our idea is to now keep on trying more such adjacent products, which the basic thesis of any such cross-sell product will be that it has to be out of this 4 crore database only. So obviously, as a DNA, we don't want to now go ahead and build a database for a completely different product profile. So the most logical financial products for us to expand into for our next phase of growth will be into secured products like a home loan LAP. It will be into credit cards. So that is something that we want to pursue as our cross-selling strategies. These are only two of the products that we have lined up for our next phase of growth. But there are several such things that we could work on. For example, a car loan. So we have, for example, a huge database of out of that 4 crore customers who have, say, a two-wheeler loan. Now, the logical next value addition or moving up the value chain for such customer would be to enter into a four-wheeler. So that's a segment that we can tap for our potential cross-selling of a car loan or a four-wheeler loan. So several such initiatives is what we want to work on for a future growth. The next would be a data segmentation, that we have got this data. How can I build better and better analytics such that my targeting of the customers is much more pinpointed, is much more relevant, such that it reduces the wastage. As I said, 40 to 80% conversion ratios is what has the it changes the entire dynamics of the margin profile between the two businesses. Within that 80%, we are obviously reaching out to much larger segment of customers, and out of which the customers are responding. How can I be more micro targeted on our customer base? For that, there would be investments required in the data analytics team that we intend to do. Lastly, on our agent business that we have, and that which is currently an 85% of our overall business, that will continue to be a significant driver for our top line. What is it that we can do on a value-added basis to which solves the life of our agent over there? Obviously, the payouts which are there, that is market determined. So you can't tinker much with that anyways. So what are the value-added services that we can give to our customers? So for our agents, there are two major pain points for his business growth. One, as we said, is access to capital, and the other is access to a good quality customer base on which he can go ahead and undertake his sales and marketing activity. So we have run pilots in the past on our database and giving that to some of our agents, and that has been quite successful. So what we have realized that with our 4 crore database, it will take us a long time to build the necessary physical infrastructure to do justice to all of that. What we are trying to do is seeing that are there ways that I can monetize this database, take it back to the same agent pool itself, and thereby help them solve their access to quality customer database issue. Because in our opinion, agent spends close to 8 to 10% of his expense of his overall business revenue on acquiring a good database. So I want to see if we can have a play on that 8 to 10% cost of the agent. So these are the broad growth drivers which we feel will help the company, which makes us very uniquely positioned, having access to a agent channel, having access to a digital channel, having access to a good and solid data analytics team, technology team, which helps to bring all these facets of our business together, and also with a NBFC, which helps increasing our overall funnel conversion. We believe that these are the things which will help drive our future growth, and we are quite confident to grow our overall scale of operations multifold from where we are and increase our margin profile in a much more aggressive manner. Yeah, I think that was probably from our side. If there are any questions, I'm sure that there are several questions. We'll be happy to take that.
Right. So thank you so much, Parag sir, for the overview of the business. So we have the first question from Rakesh Kumar. So he said that please help with past year's net delinquency rates and credit cost numbers, and also please explain the pointer with no credit risk on the balance sheet.
Yeah, I think Rashi just to answer this, and I think we missed this point.
Yeah.
See, the business model does not take any credit risk. The credit risk is borne completely by the lenders on the platform, right? Our job is to find the best possible lenders for the customer set that comes to us. So we are largely in the
Aggregation business.
in the loan aggregation customer acquisition side. The entire portfolio in terms of underwriting is managed by the lenders directly, right? So the income that we generate essentially on the loans is basically a commission for every successful transaction on the platform. So there is no underwriting risk that or balance sheet risk that is taken by the organization. That is all borne by the lenders directly. So yeah, our job is to just ensure that we are able to pass the most relevant set of customers to the respective lenders, and for the customers find the most relevant set of lenders through which they can get the credit from. Beyond that, we have no responsibility on the underwriting process, and the credit risk is borne directly by the lender. So hence the delinquency rates or credit costs, etc., do not apply to our business model.
Right. Thank you. Thank you so much, sir. Just want to say that if anyone has any questions, please feel free to put it in the chat, and I will try to cover as many questions as we can. The first question, again, we have from Pushkar Jain. Would you like to unmute yourself?
Yeah, hi sir, I'm Pushkar Jain from Mili Capital. My question was regarding the margins. How do you how the margins trajectory will pan out as more customers are given loans through our digital channel, and what the trajectory should be like?
Yeah. So Pushkar, I think there are, from our business perspective, I think if you were to talk about, in the coming years, there are three levers in the business which are critical. And I think from there, both the revenue growth as well as the margin growth will come from, right? The first lever is the contribution of the digital business to the overall pie. So as Parag mentioned in the presentation, in the past, that number was in the range of 85 to 15. 85% of the acquisition comes from the agent marketplace, 15% comes from the digital channels. I think we are projecting that in the future, that number for the digital channel would be substantially, right? So that is the first lever, because obviously, as you mentioned, that the digital business is 3 to 4 times more profitable compared to the traditional business. The second piece is how do we increase the margin in the digital business altogether? Now, that will happen by solving for the adjacencies that Parag spoke about, I think, in his presentation. Because today, if we have an X number of customers coming into the funnel, our ability to monetize a larger audience depends on the total number of products that we are able to offer on the platform. So today, large part of our digital business is personal loan, right? But now we have, over the last year, diversified into adding other products, other digital products on the platform. So digital gold loans, used car loans, etc. have been added. Also, more lenders are getting added to the digital platform. And we are also building more end-to-end journeys on the digital platform. So that will ensure that we are able to now use the same funnel of customers who are coming in to be able to give them more credit offerings. And hence, the cost of processing these transactions and the marketing cost comes down, and the overall margin in the digital business goes up, right? I think in addition to that, some of the other products that we have created, which we are able to embed with the loans, like the health and wellness product that Parag spoke about, also helps us grow the margins in the digital business. So that's the second lever, right? The third lever is obviously how do we grow the margins in the traditional business. Now, obviously, payout as a mechanism is very difficult for us to use as a lever to increase margin in the traditional business, because that is largely dictated by the market scenarios and the market rates. So what we are doing is creating a list of value-added services that we can offer to our agent network, largely related to, again, database, CRM solutions, ability to access new lenders, etc. By offering those premium services to our agents, we foresee that there could be a sort of maybe a couple of basis points addition in the overall margins in the agent business. But given the size and scale of the agent business already, even a couple of basis points, sort of change in the margin profile has a very significant impact on the bottom line. So with all these three things coming together, we expect that the margin profile of the company can significantly increase. In addition to that, obviously, because we've already created a very large database, our intention in the future is also to keep looking at ways and means of monetizing this database. And given the fact that a lot of the monies have already been spent historically to acquire this customer, whatever incremental monetization opportunities we are able to create on this database will obviously come at margin profile significantly higher than our traditional businesses. So I think a combination of all these factors coming together, Pushkar, will be where the margin profile will sort of increase. And I think the proceeds, and if you look at the proceeds from this round, it is largely tailored around that specific need itself. Because we spoke about, investing in the agent network, we spoke about investing in technology and marketing to grow the digital business, and also to use analytics, etc., to create more opportunities within the sort of customer pool that we have created.
Yeah, just one more question on that. I just wanted to ask, how many DSAs are there currently? Is there any data? What market share we have, and theoretically, how much agents we could have on our platform?
Yeah, so I think let me answer that at a very high level. Of course, very difficult to give you an exact number of how many DSAs in the market. But if I was to just draw the landscape of the total loan pie, right? So roughly we estimate that there's around a 1 lakh crore of monthly disbursals of unsecured loans in the country. This is across personal loans and business loans put together, right? This is across all the institutions put together, right? Now, out of that 1 lakh crores of monthly disbursal, you can roughly say that maybe 50 odd % would be acquired by the banks directly through their proprietary channels. Could be branches, could be their internal sales teams, could be existing digital channels of the banks, etc. And 50 odd % of that is acquired through third-party platforms. Third-party platforms could be platforms like us, could be small DSAs, big DSAs, could be pure digital platforms, could be partnerships with platforms like Paytm, etc. Now, out of the half of that is around 50 odd thousand crores, right? We are currently at a disbursal run rate of around 1,000 odd crores. So we are probably of the DSA market, or rather the third party market, representing 2% of the monthly disbursals. Out of the overall pie of monthly disbursals of around 1 lakh crores at 1,000 odd crores, we would typically be representing a 1% of the overall market. So that also tells us that there's a significant room to grow by gaining market share. And obviously credit as a principle will also continue to grow. So this 1 lakh crore, if you were to look at it, what it was maybe 3 to 5 years from back, that number would have been much, much smaller. And I think if you were to take a view of 3 to 5 years from hence, that 1 lakh crore number would also be much larger. So I think there's a significant growth opportunity available for platforms like ours, where we could grow not only by gaining market share, but also growing along with the size of market growing in the future.
Okay. Thank you so much, Pushkar, for your questions. So I would just encourage everyone putting questions in the chat. Feel free to just raise your hand and ask your questions. So the next one in the queue is Baj Raj Neher. Baj, feel free to unmute yourself and ask your question.
Yeah, thank you very much. Just my two questions I have. One, you have mentioned that you will be sharing your database with the agents going forward. So is there not a risk involved in that, whether agent can directly deal with the lenders? That is my question number one. And the question number two is that what kind of growth you are seeing, whether you can give the numbers down the line for 3 to 4 years down the line, what kind of growth we can expect in percentage terms? That is my two questions.
Right. So I think to answer the first question that you had asked regarding the sharing of the database. So idea is not to share a database with the customer. So we have this database on which we are running our data analytics and our marketing campaigns such that they are pre-approved with the rule engines of the lender. Now, as I said, once we send out these marketing agents, we have our entire call center, which nudges the customer to complete some of the steps and eventually get the loan. Now, I have two ways to completely and fully exploit this database. One is to set up my own team and my own marketing channels and wherewithal to do justice to that database. Still, there are a lot of pre-approved customers that we are not able to do justice with. Now, can I give some signals on those customers to my agents? Can I say that this is a customer who potentially has a 5 lakh pre-approved loan with a particular lender? So that is what we intend to do with the customer rather than just giving them a name number. And since they are sitting on my data lake, I have full rights on those customers, and I have the necessary approvals and authorizations to contact the customer through various channels.
Also, I think we are looking at solving this through technology, right? Because the idea is obviously we cannot share the raw customer database with any of our lending or of any of our agent partner. Right. So we already have all the tools in place because, for our digital business, we already have a proprietary CRM. We have all the integrations of a marketing suite, sort of a calling suite, etc. built in. The idea is that we want to give access to that suite to the agents. The data remains protected. It's completely compliant. We are an ISO 27001 compliant organization. So every sort of the entire customer database obviously sort of remains within our data lake. The idea is to give access to some of these tools to the agent so that they are able to run their operations more efficiently within our ecosystem. I think the point that Parag was making is that, see, if you look at pure digital marketing, right, for any campaign that runs, right, typically in a best case scenario, you will see 2 to 3% response rates on all marketing campaigns. There are no marketing campaigns run by, I think, any platform anywhere in the country or the world, which will give response rates better than 2 to 3%. Right. So for 100 potentially targetable customers, pure digital marketing campaigns will bring in only 2 to 3% of the traffic. Right. So the rest of the customers, it's not that they do not have intent for credit products, but just that the marketing mediums are limited by their reach and the ability to bring in a larger chunk of that customers. So the idea is that the customers who have some kind of an offering available but are not responding to our marketing campaigns, that is the process of customers that we want to activate via the agent ecosystem within our sort of overall technology stack, right? That's the data monetization piece that I think we were referring to.
So over there, we today have, for example, our own internal teams who log into that platform and try to take the customer through the entire loan journey. Now, I can invest X amount of capital to build that scale. We are looking at, can I solve that in a variable cost fashion also? Can I share that entire same suite, the same platform and the customer marketing tools to some of our agents? That gives him the ability to upsell his sales initiative. And more importantly, it builds a stickiness for the agent. There is no reason for him to then, keep looking around in case that becomes an issue at a future date. So that builds a very, very strong moat for our agent business also.
Yeah, and I think in terms of your second question, I think, while it's we are not at the liberty of giving you exact numbers of projections of growth, but I think you can be rest assured that, I think initially Rashi mentioned that we have grown at a CAGR of around 28 odd %, right? So you can be rest assured that the company with the infusion of the capital will want to grow at a CAGR which is similar or if not better, right? So I think from
Much better than
that. So obviously from a growth perspective, we will have significant growth. And also I think we spoke about us having one of the best, capital efficiencies in the market in terms of the ROCE returns. We would obviously want to improve that by continuing to remain significantly efficient. So I think from both those fronts, we project that there would be significant growth, but I think it will definitely be better than the CAGR returns that we've been delivering with very frugal methodology and with very limited capital.
Thank you. But just one add-on thing, basically, on the digital platform, you are right now having 15% share.
Right.
So what kind of growth here we can see in next 2 to 3 years' time?
So
how much profiting to
So we would want to, increase the market share of the digital business without compromising the growth in the agent business. So the idea is that if the overall platform will potentially give, the returns that we spoke about, the digital business will have to grow faster to increase its own sort of contribution. So I think we think that this sort of number, which is at 85-15 currently, we would be looking at least the digital contribution becoming at least twice of what it is currently.
So just to give you some benchmarks for large established brand institutions like a bank, for them, their internal business is 60%, and they still depend on third-party distributors like us for the remaining 40% of their acquisition. For NBFCs, that number would probably be in the ratio the other way. That 70% would probably 60 to 70% will be coming from third-party distributors, and 30 to 40% will be from their internal marketing and sales efforts. So that is the range that we would want to, somewhere in between is what we would strive to attain over the next 3 to 4 years.
Thank you, sir. All the best.
Thank you.
Thank you.
Great. Thank you, Raj, for your question. The next question I'm going to take is from Harsh. So his question is, will the risk increase by booking loans in your NBFC? And what type of book will you look to build in the NBFC? Also, if heard right, you're raising funds at the NBFC and Finbud will invest 15 crores in the NBFC. So what is the total raise and what percentage will Finbud continue to own?
Okay, I think a lot of questions on the NBFC. Let me try to sort of in one sort of answer give the entire context of why the NBFC, what we are planning to do there, and what the structure will look like. I think that will answer all the questions related to the NBFC. So I think the NBFC, the thesis for us, we've had the license from 2019, right? We applied for it in 2018. We got the license in 2019. We have kind of kept it as a strategic asset, but with limited capital, obviously we've had very limited activity in the NBFC. But we've been compliant from a RBI standpoint in terms of whatever needs to be done to continue to own the license, right? Now we've kind of thought about three things, right? One is to execute and be successful in the lending business. You largely need a very, very high quality team to be able to execute that, right? Who needs to have complete independence and sort of complete control in terms of what they are building. So I think when we got access to the right team, obviously with the ability to infuse capital, that's when we've decided that it would make sense for Finance Buddha to sort of venture into that. Now we have access to a very, very high quality team. The CEO has already been identified. He's someone who has over 3 decades of experience in the lending business, has led very large roles in multinational banks like Citi and HSBC, all the way up to being like India head for some of these businesses. He built the entire consumer lending business for Paytm. Prior to that, he's built these lending businesses for a few NBFCs. So a stalwart in the industry, and who would now continue to have a significant skin in the game to kind of build that out. Along with that, he's brought together a great team who again has deep understanding of building NBFC businesses with experience in platforms like Navi or Credit Saison, etc., who have come on board to sort of build that out. Now, the idea here is, from an NBFC standpoint, it is going to largely address the middle income Indian, who's looking for credit products, both secured and unsecured in nature. So customers within the range of say 4 to 12 lakh rupees of income, which we can categorize as the middle income Indian, which incidentally also reflects 50% of the database, right? So we want to kind of build products for that universe, both secured and unsecured. Of course, to start with, we will be started with unsecured products, maybe over the next 36 to 48 months, diversify into building secured products as well. So the idea is to kind of build that sliver out on the NBFC. The advantage that the NBFC has is a great starting point, because they get access to the distribution of Finance Buddha. They get access to building their risk models on data that is already available on the platform. And as we know very well, that a pre-selected risk model will always perform better than an incoming risk model. So they have the advantage of being able to build this sort of out from a sort of pre-selection basis, right? In terms of of the overall sort of NBFC pie, I think of course NBFC it has to be built from an arm's length perspective, and obviously both in letter and spirit we want to follow that. Also, the NBFC tends to be a significantly highly regulated business compared to our distribution business, and hence from an arm's length structure, it's important to have a completely different management team with full autonomy of being able to execute and an independent board. So that is what we are looking at setting up in the NBFC. Right. From an ownership standpoint, I think we expect that post this round of dilution for both the management team and the incoming investors, Finance Buddha will be left with a significantly large stake. Difficult for me to comment on the exact number, but it would, because I think we will appreciate the fact that we started at 100% ownership. So obviously we will continue to own a very significant chunk of the NBFC.
So as we said, they are also in the market to raise a significant amount of capital. But that's still in a work in progress, and hence I do not have details to share around with that.
But I think overall round that we are targeting in the NBFC would be around 75 odd crores of seed round. Out of that, 15 crores is what, as Parag mentioned, is going to be our contribution. The rest will be raised through external investors. That conversations are ongoing, and we are hopeful that post closure of our IPO round, we would be in a position to close the round on the NBFC as well.
Great, thank you, sir. So the next question we can take is from Pranay Agarwal. So yeah, feel free to ask your question, Pranay.
Yes, no, thank you for this presentation. I had two questions. If we were to just take a step back and understand the platform, if suppose there is a borrower who wants, say, 1 lakh rupees of personal loans from an NBFC, if you can just walk us through how Finbud comes in that transaction, both through the agent and the digital platform, because I'm having a little bit difficulty in understanding how we are serving the agent and how we are serving the borrower and the lender landscape through the digital platform.
Right. So let us just assume that you are a customer who's looking for 1 lakh rupees and an agent has interacted with you in the physical world, right? So that is a customer who will be brought in by the agent. There, the customer acquisition is largely done by the agent. And once the interaction between the agent and the customer has sort of happened, and the agent has kind of profiled the customer for basic credit checks, he would then be bringing the customer onto the platform, right? So here the acquisition is done by the agent, and the processing and the matchmaking and the sort of the operations part is handled by the Finance Buddha engine, right? So essentially, if you are looking for 1 lakh rupees and an agent, say Mr. X has met you, Mr. X has now communicated to you the documents that are required. Mr. X has possibly collected a pieces of information from you and now is bringing your profile to our platform, right? Once he now puts in this information on the platform, our recommendation engine will tell Mr. X that you are eligible for a loan from HDFC Bank, which he would then be communicating it back to you, right? And then if assuming that you are interested in moving forward, the entire process would be managed between the agent and Finance Buddha's ecosystem to take your transaction to closure, right? Now, if the customer has, for example, now you have consummated for a loan and you got a 1 lakh rupee loan, right? Now your details are available on my platform, right? So I have all the piece of information that Parag spoke about: demographic, income, employment, credit bureau data, right? Now, over a period of time, maybe say after 12 months, we would then obviously, based on our propensity models, based on analytics, be able to predict that you would be looking at say an incremental loan 12 months from now, right? Now, if my models are saying that, hey, you would be interested in potentially looking at a loan 12 months from now, I would then be using digital marketing to reach out to you 12 months hence and tell you that, hey, there you are already pre-approved for now a loan maybe up to 5 lakhs, because we would have profiled you, we would have shared, done some work in the background with a few lenders, and a lender would have sort of given you a pre-qualified approval for say 5 lakhs basis your profile that is available on the platform. Now we would be using the digital channels using say WhatsApp or email or SMS, or discovering you on social media platforms like Meta or Google, showing you an ad saying that, hey, you are now eligible for a 5 lakh rupee loan. Would you be interested in sort of consuming that? Now, assuming that you again show intent, you would now directly land up on a digital platform, right? And assuming that all the information that is available with us on the database is matching with your updated information, or we give you the opportunity of updating your information. Once you do that, through a completely integrated digital model, we would be showing you some incremental offers from the set of lenders where we have pre-profiled you, right? And then, assuming that you are continue to remain interested for the loan, for the terms and conditions that are being offered by the bank, then the entire process happens on our platform. So we have now done discovery of you, and you have discovered the loan product. We would now be taking this discovery process all the way to disbursal, which could involve, a few steps, including KYC, including, assessments, including some incremental bank statement sharing at your end, or some incremental information, etc. The entire process happens at our end. The only piece that the lender does in this scenario is the KYC, because from a regulatory standpoint, the KYC has to be done by the lender. Once they have done once they have completed the KYC and the entire process has been completed, the loan gets disbursed to your bank account. So that is the difference between the agent business and the digital business. So typically the first loan on the platform is brought in by the agent. Over a period of time, the cross-selling, upselling is what the digital platform is used to do.
Also,
Okay,
what the
okay.
key difference out here is that in the first leg, when the agent had gotten the customer onto our platform, as I said, there is a 40% chance that you would end up getting a loan, because at that point in time, I do not have any insights in you. So I have to gather all these information, punch it onto our platform, and then send it to the bank for their final approval or rejection. And that number roughly is at around 40%. In the second loan, once I have all your details, I have already pre-screened you with the rule engines of the bank. That ensures that finally, if I'm able to find you, and you are able to show an interest, the approval rates will be as high as 80%, if not higher. So that makes the difference in the entire margin profile of the two segments.
So the digital business is largely an analytics and a data business, right? Because we are running propensities at our end to predict the ability for you to get a loan with a high degree of success. We also trying to predict that, boss, this is the time when you would be looking for new credit, right? Because so while we have 4 crore customers on the database, it's not that every customer at all points of time is looking for a credit product, right? Now, if we were to continuously market to 4 crore customers at all points of time, the marketing cost would be prohibitive.
So what happens, for example, most of the banks, they have some cool off period. Now, in my second leg of the transaction, I know that you have gotten a loan today, and I know that bank A, B, C do not give another loan before 6 months. So I would not market to you. I know bank XYZ will give only after 12 months. So I will not market to you for those banks. Whereas on the agent-led model, I don't know. You might have, just applied for a loan and gotten a loan 3 months back, but still it will come into my system. I will put in the effort, and hence the margin profile will be lower because there's only a 40% chance of you getting that.
Yeah. So it's basically.
That's very helpful. So what we understand is that the agent business is basically like a feeder and a foundation for the core digital business.
That's right.
And they're in fact acting as our customer acquisition effort to get the customer to the digital platform so that we can then engage with the customer.
That's right.
And that is why we said that we are probably the only large player who has both aspects of this business. So you have aggregators of the world who are probably larger than us, but do not have the subsequent sell and the cross-sell upsell engine. Whereas the online players like the PV Fintech only acquires customer through a Google.
So basically, see, the thing is that today, if I was to just acquire a customer in the digital world, it's extremely expensive to do it, right? Because you don't know who is going to come into your funnel, right? So essentially for us, the digital business is a retargeting business, because the guy is already in my funnel. I'm just targeting a specific set of users from my database, and hence my costs remain low. if I was to go out and spend money to acquire a new customer digitally, there is no way that my cost structures will be any different than a PB Fintech or any of the other digital platforms, because
Right.
essentially the customer acquisition is happening on Meta and Google. So the cost there is pretty standard, right? So I think the way we have kind of built it is, as you rightly mentioned, the agent business serves as a feeder and
Right.
creates a high quality customer database, even though with a lower margin profile. And then our
Okay.
ability to kind of upsell and cross-sell to this customer base is where the value gets created.
Okay, no, thank you for this. This is, brings a lot of clarity, and I think it's a very creative way of doing business. Just my last question would be if you could give us some color on, I'm assuming for FY25, say $100 of loans were processed through your system, both agent and digitally. About 80 to 90% would the end lender would be an NBFC, like something on that. And what is the average ticket size of lending that is happening? Just some broad color on that.
So I think the top 5 lenders, I think we can speak about, I think it's part of our DRHP as well, right? They contribute around 60% of the overall pie. They include the likes of HDFC Bank, ICICI Bank, Axis, Kotak, Bajaj. So the top 5 incumbents are pretty much the top 5 guys with market share, right? So we are kind of fairly representative of the market that way. It's a combination of banks and NBFCs. Obviously, because we are, again, as Parag mentioned, I think initially, that we are well diversified across all the states, over 19,000 pin codes. So we are fairly representative of the market. It's a combination of banks and NBFCs. Of course, the digital business is more towards the NBFC and the fintechs. The traditional business is more towards the banks and the larger NBFCs.
Right. Thank you so much. Best of luck.
Thank you.
Thanks.
Thank you, Pranay, for your questions. We can take the question from Astha. Perhaps would you like to unmute yourself and ask the question?
Hi team, thank you for giving me this opportunity. Sir, I would like to ask you a couple of questions. First, I wanted to ask you that we have relatively high receivables in this business. So can you please tell me what is this due to?
So our average receivables, as we had said, is typically it can stretch up to 90 odd days. So all our receivables are either through banks or NBFCs. So we do not have any revenue which is other than receivables from banks and NBFCs. And that is typically in the 60 to 90-day range is what our receivable period would be. And that is what it is reflective of. So over there, as our contribution of the digital business increases, and as Parth just mentioned, that the digital business works mostly with the fintechs and the NBFCs. Over there, our receivables are slightly longer compared to, say, a bank like an HDFC or an ICICI. But yeah, at a mixed level, it would be between 60 to 90 days.
Understood, got it, sir. So my second question is related to since we don't have this NBFC business right now, we started it last year, right? The operations kind of started in last year. So I'm assuming that whatever financials we have, they are standalone financials for lending aggregation business, right? Majority would be that.
100% Astha is the loan distribution business. The NBFC operations is not underway. As I mentioned, the team has just been identified. The idea is that we will first be doing the seed infusion in the NBFC via the proceeds of the IPO, and post that the operations will really start scaling. So at this point of time, the entire revenue that is being represented is from the distribution business.
Got it. And so my last question would be, is it possible to have the details of board of directors? Of both holding company and NBFC, including their investments made by them?
So I think it's publicly available. I think the board of directors are.
So we are the three of us are directors. Then we have three independent directors, 2 independent and 1 executive director. So one of the independent director is a lady called Payal Shah. She earlier on was a investment professional with Sequoia Capital.
Previously, she was a consultant with McKinsey.
And prior to that, a consultant with McKinsey. Over the last 4-5 years, she has dedicated a large part of her time in the NGO space. So she's one of the independent directors. Then we have a gentleman called Ajay Vikram Singh. He brings onto the table a lot of financial services and lending experience on our table. He's an IIM Calcutta graduate. and has worked with a bunch of large international organizations like Citibank and certain large domestic lending players. And then we have a gentleman called Praveen Kavuri, who's on board. Praveen, he is an IIT Kharagpur graduate. He had founded and successfully exited out of his company called Cake Zone. He had sold it out to Pure Foods. And currently he's an entrepreneur with several interests. So these are the independent directors along with the three of us on the board. On the past. Yeah. And in the NBFC, currently it is only me and Parth who are the directors, along with Payal as the independent director representative from the parent company. So once we get this investment into the NBFC and once the operations start, the idea will be to broad base the directorship of NBFC and bring far more experts,
seasoned professionals, basically
people with expertise in the lending space on board. We are already in discussions with a few of them, but we are waiting for the round to get concluded for that to happen.
Okay. Thank you so much.
Yeah.
Thank you, Asta. The next question we can take is from Paras. Go ahead, Paras. You can unmute and ask your question.
Yeah, thank you. So just wanted to understand what would be our approximate EBITDA margin for the agent-led aggregation model versus the digital model? Just the approximate EBITDA margin of both.
So I think Parag touched on the agent business EBITDA, that is between 4 to 5%. Currently, our digital margin is 3 times of that, right? I think we think at scale that number could be maybe 4 to 5 times also. So I think that is where the expansion of EBITDA will sort of take place. But that is the current margin profile.
Right. And my understanding, and correct me if I'm wrong, once the agent gets a client in the first credit lending, etc., and then when you remarket another credit line to a couple of months or years down the line, any kind of commission sharing with that specific agent is not into the picture.
No. So the agent is a hunter by nature. He is large. His large part of his role is limited to bringing in new customers to the platform. Very similar to how the bank also looks at credit customer acquisition, right? So if you are, as I mentioned, that for even the large institutions like HDFC Bank, say 40% of their customers comes from third-party channel. Once the customer has been acquired, you would have seen that the bank start remarketing to those customers after a period of time. And obviously, there is no revenue share that is available to even platforms like us if the customer is sort of consummated by the bank directly. So the same philosophy is with which the lending aggregation business operates, where an agent is paid for the first loan. Of course, if he is able to bring the same customer back and get him consummated in another lender, it's as good as a new loan and he'll get paid for it. But contractually, there is nothing that ensures that the agent would get any kind of a renewal commission. This is unlike the insurance or the investment space. I think this is a standard practice in the lending aggregation space.
So while our relationship with the agents are long-term, but from a pure business point of view, every customer is a one-time transactional relationship, both from an agent to us as well as from us to the lender.
Yeah. Correct me if I'm wrong, your cross-selling products, the revenue from that is...
Sorry?
The revenue from cross-selling products to the clients already on the platform, right? That is hardly there or very minimal. What percentage of FY25 revenue would that be? Because that's the real monetization of the database, other than, of course,
So I think the way to look at it is we look at even digital lending as cross-selling, right? Because primarily it is available only to a set of customers that is available on the platform, right? So while cross-selling as an activity is something that we spoke about, the entire...
What percentage of our FY25 revenue would that be?
15% is what we have generated by the digital
channel. That's on digital lending. I'm saying on the cross-selling of other products.
No, so what I mean to say is that when you say cross-selling of other products, right, essentially us selling a digital loan to a customer being acquired through a physical network is also categorized as a cross-sell internally, because this is a customer who's already available on the base and we have sort of gone to the customer with an incremental opportunity, right? So cross-sell is, so I think
in our DRHP, we had also mentioned that for the last year, that cross-sell number was sub 1%. So obviously that is when our entire efforts had just started about. So it is sub 1% of the overall revenue. But if you look at it, that out of the 15% which comes from the digital, this 1% is also part of that.
No,
But yeah, our
understood.
idea.
Yeah, but at the moment, the other products have not made a traction into the cross-selling business so far.
So I think because I think that a lot of that requires us to invest a lot more in technology and analytics, right? And I think as we mentioned that we have been very frugal at our just from a company journey perspective. I think the only sort of external equity that has gone into the company is only around 19 odd crores. Out of that, also 15 crores was infused only last year, right? So I think we've kind of built it step by step. Obviously, the first activity was to ensure that we are able to collect a very large database. The first opportunity was obviously to monetize it using digital lending, which is what we have done successfully. And now it has contributed around 15 odd percent. Now, the idea to expand the digital pie will obviously be to add other products. And I think this is something that Parag spoke about, a health and wellness product, which is already hit around a 50 lakh rupee monthly premium collection now, which is embedded with the loans.
But the entire impact of that is
still not coming in. That's where I think the operating leverage will also come in the future. That customer acquisition is largely happening through the credit route, but our ability to kind of monetize that audience by offering other products, including other credit products like gold loans and used car loans, is something that we have initiated over the last 6 months. We would obviously be deepening that by adding more products and also going deeper in these segments. But I think the early signs are very encouraging. The fact that within 6 months of launch, we are able to now hit a 50 crore monthly disbursal on gold loans with a potential to scale this manifold and also be able to collect around 50 lakhs of premium on the health and wellness product is giving us confidence that the contribution of some of these incremental adjacent products will only go up in the future. Once we make significant investments in technology and analytics, that's where the real unlocking of value will take place.
Okay. And just last question, Mayan, from the NBFC business, when do you expect it to, commence the operations, and what proportion of your revenue do you expect 3 years down the line from the NBFC?
So I think the commencement of operations is typically post infusing of the capital. So I think you can typically look at it maybe most likely in the next calendar year is when the operations will start. Maybe in the next financial year is when really the scale up will happen. I think from a contribution perspective, I think as I mentioned, that this is more a strategic investment for Finance Buddha, right? So I think, and NBFC by nature is a very capital it requires a lot of capital, right? So we would continue to get diluted in that business. So, I think at this point of time, we may be majority or maybe just close to majority post the first round. But over a period of time, we'll continue to get diluted. And there's a possibility that maybe in a 3 to 5 year horizon, it will remain a financial and a strategic investment rather than necessarily representative of a financial investment. So I think that is how we look at it. So for the shareholder who's coming into the parent entity, this creates an optionality value that you are able to get access to value that gets created in the NBFC to the extent of the Finbud holding. But from a purely operating perspective, the idea is to sort of run it at arm's length. And given that the nature of business is a completely diverse and the capital structures would also be very, very diverse, the idea is not to necessarily keep it within the group and have sort of a consolidation of financials over a period of time. The idea is to look at it more as a strategic investment.
Yeah, thank you. And I mean, just before I you've mentioned, your expected growth rates could be in line with the historical growth rates or maybe better, depending on the IPO proceeds, etc. What are the risks? What risks do you foresee in achieving, that kind of growth rate?
See, I think credit markets, the risks are all macro in nature, right? Because I think essentially, as a fundamental rule, and I can just put a thumb rule here, right? Whatever is the GDP growth, 2x of that is credit growth, and 2x of that is unsecured credit growth. That is over a period of time. If you look at historical data, that is how it works, right? So I think the real risk in any lending oriented businesses are more macro in nature, right? Of course, if there is if there are job losses that happen at a mass scale or any kind of a turbulence sort of happens in the economy, or there could be like events like COVID, etc., then obviously those risks are always there in any kind of a lending business. Obviously, the other risk is regulatory in nature, right? Because the regulator keeps adding various dimensions to the sort of the way loans are originated, either by capping interest rates or cutting down some segments, or I think you would have read over the last year the risk weights on unsecured loans were raised. So some of those cyclical risks which come in through a regulatory environment continue to remain. But I think at an overall level, I think the point that needs to be thought about is, largely consumption in the country is being driven by credit, and we have kind of migrated from being a savings-oriented economy to a credit-led economy, right? So I think credit markets are already very large. Over a period of time, credit markets will become even larger. And it's a business which allows many people to play, many models to survive. And that's why we already have so many financial institutions, and each financial institution brings something to the table. So I think that will continue to remain. I think so. In terms of just the opportunity of the credit market, it's very, very large. And it's not a winner take all market. It's a market where many players will survive with different business models. So I think we are confident that in the future, we will be able to tap into this opportunity. And given our sort of business model, which is very diversified and unique, we will be able to grow at growth rates which are better than the market for sure.
Understood. Thank you so much for that.
Great, thank you, Paras. So the next question we can take is from Devansh Dhruv. Yeah, you can go ahead and ask your question, Devansh.
Hi, thanks for the opportunity. 1 second. Hello. Yeah, so my question is there any candidate in pipeline that you have identified for the NBFC? Because you might need a seasoned face, right, to scale up the NBFC. So is
I
there
think we just spoke about this, Devesh, is that we've already identified a CEO, somebody who brings in over 3 decades of experience in lending, somebody who has run a very large billion-dollar balance sheets, both at multinational companies like Citibank and HSBC, also set up the consumer lending business for Paytm. Prior to that, set up a bunch of lending businesses for large NBFCs. So we've already identified the CEO. Yeah, so I think
So we have identified that. We are in discussion with them, but officially anything will get closed only once we are able to do the fundraise at the NBFC level, which will happen post the IPO. But yeah, we have been in discussion with this gentleman. We have known him also for some time.
Okay, and so NBFC, for NBFC, what are your plans? What are the type of the loans that you want to work on? And also, would you start with co-lending or so?
Yeah, so I think obviously, lending. So I think the thesis there, I think I've sort of mentioned this before. The idea is to build products for the middle income Indian segment, which is the 4 to 12 lakh rupee income segment. Build a combination of secured and unsecured products so that we are able to take care of the credit needs of this segment over the life of, over their sort of life, and create a large sort of a lifetime value for us. In terms of the strategy, of course, all options are open, including co-lending, on-book lending. But I think that given the fact that we already have a very large distribution pie, which is currently in the tune of from our last year 7,200 crores of disbursal. This year the number is much larger than that. So I think the opportunity is very, very large. And to do justice to that opportunity, I think a combination of strategies like co-lending and on-book lending will have to be followed. But I think at this point of time, from an NBFC standpoint, the sequence of events are such that first the idea is to obviously close this round, infuse capital, bring in a high quality management team, build in differentiated products, and then kind of think about a capital deployment strategy which combines a on book plus a co-lending kind of a play. So I think that would be the sequence with which the NBFC will sort of move forward.
Fair. Thanks for answering. Thank you.
Right. Thanks, Devansh. The next question we can take it from Rakesh Kumar. Rakesh, please feel free to unmute yourself.
Yeah, hi, sir. Once again. Can you hear me?
Yeah, please go ahead.
Yeah, so just in relation to the prior question, when a customer is acquired directly through you or through an agent, and when that potential borrower is sold to a bank or NBFC, so during the life cycle of the loan life cycle of the borrower, who owns that particular borrower at different stage? Because that would enable us the cross selling strategy or cross selling opportunities. Certainly the NBFC, as and when you start, that would help you that to lend from your own balance sheet at the later stage. But till the time you are you are showing that potential borrower to the bank or NBFC, who owns that borrower at different stages?
Yeah. So I think while I said, say honestly, I wish I could say that we own the customer end to end, but I think that will be unfair, right? Obviously, once the customer has transitioned onto the bank balance sheet, the bank also kind of owns the customer, and it all comes down to the ability to kind of retarget and remarket, right? So it is a very competitive space. I think the same set of customers are available on multiple platforms. Even a customer, for example, who got a loan from HDFC Bank but has a bank account with ICICI Bank, like owns the customer, right? Both of them will sort of claim ownership for the customer. So I think it's very difficult to kind of pinpoint and say that Finance Buddha has the ownership and HDFC doesn't have the ownership. I think we'll be fooling ourselves by sort of believing that.
So it is a multi-ownership industry structure.
Yeah, so it's a multi-ownership industry structure. There is no specific ownership, but at the same point of time, there is no contractual, sort of limitations in terms of what you can do with the customer. So it's also not that any of our contracts with the banks or the NBFCs are prohibiting us from carrying out any incremental activity with the customer. So from that perspective, it's fair game in terms of who can get to the customer, in terms of the product that he needs to offer. But I think that the key piece here is that, see, a bank has the ability of offering only its own products to the customer, and not every customer meets the requirement of every single lender. And customers look for variety and choice, and it's the principle of choice which is the reason why platforms like us exist, right? If every customer was happy with the bank that they were banking with, there would be no reason for platforms like ours to exist. But the fact is that either because of the fact that the customers look for choice, or the fact that there are inefficiencies in the banking ecosystem, or thirdly, that not every customer who's a bank customer has potentially the ability to borrow from its own banker, is the reason why opportunities are available to platform like us. So that's where we operate, right? And so, there is a customer who's available on our database where we would be marketing to them with specific offers that we may have. And the customer may also be on the bank database, and the bank could be marketing to the customer with the offering that it has. Now it's up to the customer to decide what it thinks is the best for him or her. Some customers who are very confident that they can bank with one financial institution and get all their offerings serviced by them, they obviously don't see any value to come to platform like ours. But there are customers who are also looking for choice and options, and they think that they have a better better suite of lenders or better suite of options available with platforms like us, rather than just the specific bank that they have offers from. So it's a multi-ownership structure in the industry, and it's the same for us.
Thank you. Got it, sir. So just slightly, extend it a bit. Like suppose, as you said that, majority of large lenders like HDFC, ICICI Bank, and the SBI of the world, once that customer has become the part of those banks' balance sheet, why would bank, not cross-sell with that particular customer and give that opportunity to you, that at the later period of time you do the cross-sell and so
देखिए
that
राकेश, principally speaking, जो आप बोल रहे हो, I think in an ideal world that is how it should be. But in reality is that even for, and I think I'll give you some numbers, and I think that will just one second. Ignore them. Yeah, sorry. Yeah. So I think the point that I was making is, if I was to give you some specific numbers, right? For a bank as large as HDFC Bank, right? Nearly 40% of their customers come in through third-party channels. It's not that the bank is not present in the locations that the third-party channel services, or a lot of these customers may not have existing relationship with HDFC Bank, but they continue to choose a channel to come from, right? So they are already sort of available on the HDFC database, but they're still choosing a third-party channel to come from. And as much as 40% of an HDFC pie is coming in through third-party channels. If you look at other lenders which may not have proprietary distribution, that the likes of L&T and Aditya Birla, etc., that number would be much, much larger. Even in HDFC Bank, right, for the customers that come through third-party channels like us, 50% of those or more than that already have an existing relationship with the bank, right? It could be a bank account relationship, it could be a credit card relationship, it could be an asset relationship. But it is just because there is so many customers and so much inefficiency that exists, that gives us the opportunity to kind of, sort of being able to bring customers. Secondly, I think it comes down to the principle of choice, right? Because HDFCs, when it is going to its customer, is going with a specific offer which is limited to what it can give to its customer. But what is available to the customer in the market may be far better, far cheaper, or far more targeted than what the specific lender is offering. That's where platforms like us come in. So I think for a customer who's, as I mentioned, who's very satisfied with his banker and wants to stick to that, there's no reason for them to come to us, right? But for customers who look for choice and who look for optionality, that's where we step in.
Got it. Thank you, sir, and all the best.
Thank you.
Thanks.
Right. Thank you so much. So we have the final question from Pranay. Pranay, would you like to unmute yourself?
Yes, thank you, Rashi. Just lastly, thank you for such a wonderful presentation. One is that just to clarify that there is no recourse to Finbud in case the end borrower defaults, whether the first EMI or the last EMI. That is the first thing. So
Yeah.
that there's no recourse to Finbud.
There is no recourse on finance
Right.
for any of the loans. Yeah.
Okay. And lastly, because we are doing a small equity raise right now, why has the management chosen to access the public markets and not the private markets? Like, what has been the thinking on that?
So we did access the private markets last year. And we have prior to that also accessed private market. So just the history of capital raise for the company, I'll lay that out for you. So in 2016, we raised our first angel round through the Chennai Angels. That round was for 2.5 crores. That was spearheaded by Mr. Shankar. He is the founder of CAMS. So Shankar, along with a bunch of, I think, 12, 13 Chennai Angels investors, they had come onto our cap table in 2016. They have been really supportive of the company's growth all throughout. They helped us survive through and cross the hump during the COVID episode. So they topped their initial investment of 2016 with another small 1.5 odd crores of funding during the COVID phase. So that was the two private rounds that we did. And then last year we had Ashish Kacholia and MS Dhoni family office who invested into the company. And hence after 3 rounds of private funding, we chose to access the public markets.
Thank you so much. Best of luck.
Thank you.
Thank you.
Okay, thank you so much, everyone, for joining the Analyst meet. Thank you so much for your time as well, for answering all the questions in so much detail. If anyone has any further questions, feel free to contact us at India Advisors, and we will get you another meeting with the management to discuss any further questions, or we can try and answer them on their behalf. So thank you so much, everyone. Have a nice rest of the evening, and thank you.
Yeah.
Thank you so much, everyone.
Thank you very much, and thanks for joining.